Today, folks, I have officially 3x leverage to the upside the real estate market, and apparently some of you in our chat group have been following suit, and we'll talk about that in the latter half of this video, but we gotta roll back, baby. I mean, look at what's going on in the markets today. It's like all of a sudden all my beautiful dividend boo-boos out there have been selling off, whereas, you know, tech has actually been getting a little bit of oomph today, but not the oomph we all really want to see, because tech, in my opinion, is still relatively overvalued. And the question is, do we see a continued tech sell-off and a rotation from, like, you know, treasuries and high interest savings and all this stuff as money market funds start to bleed as the interest rate cut cycle begins into the lower half of the market? I mean, that's the rhetoric that I've been pumping on this channel for far too damn long, and it's going to be neat to see how that thesis plays out, because when it comes to the tech sector, the darlings like your Nvidias of the world, everyone was pump until the dump in earnings, and now all of a sudden it's overbought. Should you be selling your chip sectors? I'm obviously don't got a real crystal ball here, but when it comes to valuations, again, value is not the entirety, like, it's all fugazi, but value is not the entire story behind stocks. But if we're talking about just value in numbers, I still think Google and Meta are the two best value plays in the market from tech today, right? And that obviously depends on how you see the future of these business models, because Alphabet is competing for search when it comes to obviously chatbots and AI. Everybody's got a chatbot, from Twitter or X all the way down to Meta. Everyone's competing, and if they start stealing market share, and I believe they are, could detriment their business, but to some extent that might be priced in. I don't know if it is priced in or not, but the price to earnings multiple, you know, the forward now is back under like a 20, and trading at a 22 is pretty low for the historical averages here. I mean, you go back to 2013, 2014, and they were trading almost up into a 30 times multiple. So this could just be signs of an aging business, but I'd still argue they have some really good growth. I mean, you take a look at revenue and profit here, and it's like they haven't even slowed down, double-digit growth. So, I mean, it's something to keep an eye on. Same with Meta. You know, my fiance owns a big chunk of Meta still. I'm still a huge believer in Meta. Every aspect of their business continues to grow. The price to earnings is still a bit high, but it's in their historical norm. So I'm very intrigued to see how Meta continues to perform. But when you look at things like Nvidia here, you can almost arguably give the same story behind Nvidia now. Like, you know, we're getting into the scale of large numbers. It's really hard to trade at a 50 times multiple where their PE currently sits with the scale of numbers that they're currently at, because getting to 100% growth rate continually where they're at is very, very hard, right? So they're definitely pricing in some of the future here, and there's still risk that, you know, the chip sales start to stagnate a bit, and that growth stagnates with it. Time will tell, but this is a low end for their, you know, their price to earnings multiple from 2020. Historically, though, we've seen them go as low as 14 back in 2013 to as high as 45 in 2017, and obviously the peak being over 100 in 2023. So I don't know. It's a wild card, Nvidia, but when it comes to the rest of them, it's pretty obvious that Tesla's way overvalued here for the growth they currently show. Apple's way overvalued here. Microsoft is way overvalued here. They're trading at all these stocks are trading at the upper end of their value metrics for the growth they're currently offering. So I'm still a little bit bearish on tech to some extent. Doesn't stop me from buying the S&P, of course, but the story today, and the story that's going to be moving the market continually, is going to come down to, are we heading into a recession, which doesn't matter because by the time we figure it out, the market's usually bottom. And the second thing is, how do interest rates affect the stock market? What does this mean for tech companies? What does it mean for dividend paying stocks? Where does all this money on the sidelines eventually start to flow into when they get tired of not being able to capitalize on high interest rates anymore? And there's a lot of money on the sidelines still. I mean, go ask Warren Buffett, right? So basically, they're saying that the Dow Jones Industrial Average and the S&P 500 are lower, while the NASDAQ Composite edged a bit higher, which we're seeing, and that's all on jobs data that paint a murky picture, because jobs data, if it does come in, you know, obviously weaker than expected, that's good for interest rate cuts. But how weak could define, you know, obviously a recession? It's kind of gibberish in my opinion. The only thing I like seeing is that used car prices are coming down. So for those of you that want to get a used car, even on Auto Trader here, we're seeing used prices come down. Gasoline prices are coming down. My dollar chip aisle at Walmart is finally back below $1. I remember it was almost $2 there not even a year ago. So prices have been deflating. We're heading into a very appropriate place for the inflationary pressures that came out of the pandemic. So I feel like we're heading back to a more nominal market, presuming there's no black swan nuclear fallout from these geopolitical events. Who really knows? There's always black swan capabilities. But if we're just talking about what we do know is the federal fund rate is going to come down. There's like a 99% certainty at this point that we're going to finally get interest rate cuts in the US, as we've been seeing in Canada. And we've seen how interest rate cuts have been affecting Canadian companies, especially the real estate sector. And it's going to be very intriguing to see if the US follows a very similar suit. And it looks like, people are preemptively buying into this story, as I have been kind of narrating it on this channel for far too long at this point, waiting for this day to finally come. And I think we've got some legs to run on here, and it's going to be neat to see how much these legs run, because a lot of people think it's priced in, and it could potentially be priced in. But I think as we head into meeting after meeting, we see multiple interest rate cuts. That this is going to continue to rally exceptionally, because it should be a one-to-one correlation to cash flow. I mean, if we take a look here, and I want to talk about this because I've been buying the Direxion daily real estate 3X bull ETF here, and this has been in the gutter. I mean, we can see that it came out of the pandemic beautifully. I mean, if you bought this during the pandemic, you saw a few 100% return, and something tells me we're going to see something hopefully fairly similar to what we saw here. The problem with these 3X leverage ETFs, they require more bull days than bear days, right? Because at the end of the day, you're 3X anyway. So if you get too many down days at 3X leverage, you're going to feel a lot of pain, right? So there's big risk with this. It's kind of like TQQQ. If you're triple leveraging the Qs, you're really presuming that over the next, depending on how long you're trading it for, you're presuming you're going to get more bulls than bear days. And I'm highly confident that we're going to see more bull days in the real estate market than bear as the interest rate cut cycle begins. That's the bet that I'm making on this ETF. And I'm going to talk about tomorrow how many shares I picked up, because yeah, I am buying this fairly aggressively. I really want to play into this because I don't want to watch it happen and be like, it was so obvious and I missed it. Because again, cash flow is directly impacted by interest rates. So if they come down, cash flow should naturally increase, and every idiot and their grandmother will realize this as they start piling money in here to try and collect higher yields while we see the recovery. If we take a look at the stocks that are in this ETF, it's primarily based off a broader index related to the real estate market, but the top holdings include Prologis, American Towers, Equinix, Welltower. I mean, it's very diversified, right? And as I've told many people in my chat group, these days, I don't mind taking on a bit more risk because it's a very small percentage of my portfolio, as I've done with Tesla and many other companies over time. But I want to do it in a way where I'm kind of mitigating that risk, because I'm not going to be buying individual REITs, because sometimes black swan events happen all the time with individual companies. Things just happen, and it could greatly affect the stock share price. So I'm like, let's just take the broader indice. If I believe it's going to be a bull market, let's just, use some leverage on it so we get excelled performance in a shorter period of time that we can take profit on, right? So we'll see how this goes. But American Tower, I think has a long runway ahead of it here. It's got a long recovery story ahead of it. Yeah, it's up 45% from the lows. It's been a great buying opportunity, but man, we're nowhere near all-time highs. If we take a look, revenues at all-time highs. Yeah, the growth rate slowed down, but if we take a look at net income is only just starting to recover, and we haven't even talked about interest rate cuts yet. So they've done a good job turning around net income, and they should see an excelled net income growth as interest rate cuts come into play, right? We take a look at something like Prologis here. This stock's done pretty well over the last 5 years. It's been in the gutter, as many stocks have in the real estate sector since the interest rate cycle happened, and their revenues have been actually great up to the last quarter, but revenues have been very stable here. You take a look at net income, and it's a similar story. Net income growth has been pretty much flat to the downside, probably fighting the interest rate cycle. So we take a look at something like Equinix. This stock's actually up. It looks like it's doing pretty well. This year it's been flat, however. If we take a look, revenues, all-time highs. But if we take a this is net income, even though net income's at an all-time high. If we take a look at revenue here, revenue's at an all-time high as well. Everything about this stock looks great, yet Equinix, hasn't seen, a whole lot of growth as of recently. I mean, they did come out of the bottom there. They're up about 61%. So it'll be neat to see what happens here, right? I'm hoping we see continued excelled performance. It's been a great REIT and very stable, right? So let's take a look at what else do we got here for, Welltower. Welltower is another one that's been on an explosive growth rate as of recently. I haven't looked into the news that's really driving this. Welltower, if we take a look, revenues have been excelling. They've been doing pretty good. Net income is back up, not back to where it was, but it's starting to perform. So I'm not sure what contracts or what news is propelling this. But again, this would be a great one. It'd be nice to have known what was going on, because it's all at 37% this year. If we take a look at the last one, Simon Properties here, this one's still way in the gutter, slowly coming out of the bottom side, up 14% this year. And if we take a look, revenues are coming back. We take a look at net income here. Net income is actually at an all-time high. And this, again, I feel like the bull thesis is, hey, real estate has survived probably one of the worst cycles that it's experienced in a long time. All these companies have done refinancing. They're all working out, the issues they had through the higher interest rate cycle. And anybody that was going to get slaughtered got slaughtered. I don't think outside of personal properties, and you can talk about the value of properties, how people are handling these payments, are the end consumer struggling? Potentially, yeah, there's going to be some mixed bag issues still, but the vast majority of these companies have stabilized. They're still doing exceptionally well. It's a highly diversified way of owning the real estate sector. And I think we're just getting started on cash flow recovery and the interest rate recovery cycle here. Now, like I said, I've been arguing with my mom about it because sometimes something seems so stupidly obvious, but you feel like you're missing something. Like, I don't know what's going to happen with Microsoft tomorrow. I don't know what's going to happen with big tech companies. Am I going to keep cost averaging into them? Absolutely, right? Like, yeah, obviously, I still want tech exposure through the S&P, and even on the individual basis, the stocks my wife owns and whatever. But when I look at this, I'm like, how? Like, am I the only one that's like, why isn't this exploding right now? Like, I don't hear anyone on CNBC talking about it. I don't hear anybody in the media talking about it. But isn't it like common sense that if we lower interest rates, real estate value should go up because cash flow will slowly start to improve over the next year or two? I don't know. Am I missing something here? Let me know what you think in the comment section below.